Good morning, this is Ken Long at Tortoise Capital with a review of the weekend trading reports for August 24th, 2018. The market is in bullish normal conditions. On an annual basis, using NDX 260, it's at 100 out of 100, deeply overbought. On a 10-day basis, using NDX 10, we are also overbought at 98 out of 100. In the market mosaic, price with respect to the 200-day moving average has improved to white bullish at 5.68%, meaning we're almost 3% above sideways conditions. Intermediate strength of trend, slope of the 50-day is red neutral at 0.3. Intermediate ADX strength of trend is still weak at 11.1, so it's been choppy. The risk index is the 30-period moving average of the VIX divided by the 10. 1.0 is the boundary between risk on and risk off. That reads at 0.981, so we're still in risk off conditions. We take that score, compare it to the last 5,000 trading days, we find the risk Z. It reads at minus 0.32 standard deviations below the long-term average, so still slightly risk off, but improving. The fact that we had a low and a higher low bodes well for potential going forward for swing trades for the next couple weeks. You can see the holdings for blended monthly rebalancing. We'll be ready to rotate shortly, but the leaders still look like leaders in the clubhouse based on Friday's closing prices. In ETF2, the theoretical exposure remains at 40% with the U.S. dominating. Take a look at some blended monthly rebalancing portfolios. Technology and the Russell both had good weeks to lock in their gains at the top of the stack. It's the globals that are on cash signals. ETF 32 portfolio evenly split between buying and cash. Healthcare, consumer discretionary joining tech at the top. Both had good weeks and months and quarters. In the Dow 30, Merck has given up a little bit this week, but remains at the top of the stack. So Apple and Nike still looking pretty strong. Had good weeks in Microsoft, Visa, Home Depot, American Express. Maybe some dead cat bounces down here with Intel and GE. In the business sectors for the U.S., again, just about everything is looking good except energy, which has given back some over the last month and 3 months, although maybe this week had a little bit of a rebound, as did oil and gas equipment. Healthcare equipment, pharmaceuticals, healthcare services are three of the top five. So you could do worse than XHS or healthcare, the sector XLV. ETF Max featuring a lot of small caps and combined with healthcare this week near the top of the stack. There's U.S. technology here and everything that's better. In the market health check, the vertical lines are 10, 20, 30, and 40 days worth of look back. The horizontal purple lines are price targets to the upside that we have basically achieved. The red lines were support levels, pushing all-time highs here. And what's nice is the MACD histogram has pulled back. It's in the fall right now, but with this curl up, it's about ready to make another leg up. That's how we interpret this. Possible crossover of the signal line above the zero line would be very favorable. That would be a resumption of the summer growing period. The last time it entered the summer was this nice period here. So good potential to the upside. ETF regional report. The U.S. sector, the four U.S. sectors are on buy signals, keeping us at 40 and 60 in the theoretical model. Bullish normal. The S&P at 72 is better than the globals at 43. Inside the U.S., the strength is in technology and small caps. The weakest sectors remain Latin America and emerging markets. Inside the sectors, it is healthcare, discretionary, and technology. In the market health check, right, market health check, small caps and tech growth are doing well in the U.S. Mixed bag here in Asia and in Europe, mostly under average. Brazil has just been getting smashed. Mexico and Canada doing okay. U.S. real estate and oil also doing fine. ETF top 30. Mexico in the green and white was good, is now great, so there's an opportunity to exploit new strength here. Potentially a new leader. The same thing with the Min Volatility Index. Otherwise, retail, small caps, technology, biotech like XLY, the discretionary spider, all doing well. Liquidity stats based on average 30 days of volume. So those are the liquid ones. Shift into the daily report. No signals in overreaction. On the short side, we'd be looking for a collapse in emerging markets in Europe. So if we get a down market on an intraday basis, and then we saw emerging markets or Europe doing worse than the S&P, that would be our auto short. 10-day max pains. Walmart has been doing really well along with Chevron, but these are opportunities for rebounds. Dow tactical summary. We have Coca-Cola's interesting. It's a doji, a channeling Avan, overreaction, and a 551W max pain with a 3.2 reward to risk ratio, good frog quality number, and 7 on the RSI too. So let's take a look at what an amazing setup that must be. So I really like Coke in here. It's had 5 weeks up, 5 days down, a doji compression. It's still in the fall, so it's above the 0 line, but it's had a nice measured pullback. Find support here around 45.50. Then the upside at 47 is the target, and if it breaks out of there, that would be the start of another leg up. So nice opportunity in Coke. Let's take a look at Chevron at 4.4 to 1 and a doji. Here we go. Nice max pain, kind of a range compression. It's had some support, higher low, and closed well on Friday. So I'm liking that as an opportunity back to the Bollinger Band mean, with it maybe a 2-day low for execution. So that would start off as a day trade, followed by converting it to a swing trade. It's in the winter of its life cycle, so another day of strength, and that would probably cross over into the spring and have room for a nice range expansion with long-term fair value up around 126. Chevron has some good potential. The downside failure, you can see why. If this does fail through a 2-day low, we'd want to be short. So it's in a critical state. Shift into the ETF 30. Volatility is leaving the market right now, in spite of what you read in the newspaper. Metals and mining would be interesting to look at here. It's 4th best on the max pain compression, 2 to 1 auto framer. good frog quality number, and it was a percent leader on Friday, so it could be the turnaround is in play. So let's take a look at XME. Beauty. Notice how this has really nice swings when they unfold. We'll have just started the swing here. You could use 33 just below the baby dragon as a support level for execution position size. 2 ATR for position size. It's just gone through the winter, and it's getting ready to cross over its own 5-period exponential. Has a target of 3750. XME is going to be high on my priority list. I really like that one. For the daily pinches and stretches, the most positive Z stretches, in other words, a stretch above their own Bollinger Band mean, Pfizer and Cisco, both well above 1.0 on their own Z score. The ones most stretch below, Brazil, Latin America, Intel, and metals and mining. That's why I like metals and mining as a turnaround. There's so much room to go back to the Bollinger Band mean and then beyond. The most expanded pinch boxes are the ones that have had the greatest 30-day directional moves to make the river the widest. So things like Pfizer and Apple to the upside, Brazil and metals and mining to the downside. That just tells you how extremely wide the river is, not whether that has been positive or negative. You can't miss what the trend was, though, when you take a look at those. So if we looked at Pfizer as an example, yeah, no doubt. There's our Bollinger Band mean pinch, or the Z3 pinch, all the way through the summer, drifting into fall, and getting ready to make another run at it. Its partner in crime, Procter & Gamble, also in pretty good shape, and it just came out of the 200-day moving average, Red Sea, if you will. It's had a nice 1, 2, 3, and getting ready to resume. If we looked at some on the other end, Brazil, what a beautiful chart. It just illustrates the power of these long swings, and when the PSAR shifts, you better pay attention. It's had 3 days to fail further, but it hasn't. It's finding support where it found support. The winter is starting to narrow, and so this is time to start stalking Brazil, and then the target right back to the long-term fair value one more time. So that looks pretty reasonable. Intel we talked about. Oh, perfect. It just started its spring, and here we go. The 10 has turned, the 30 is getting ready to turn, the dragon's turning, so this is basically an owl. You'll find a lot of owls occurring right around the spring. It seems to be the season of the owl. So one of the things that we can do is shift ahead. You already know how to do these auto framers and daily squeezes. But if we look for in the spring, Intel and 3M. So these mean that the MACD signal line has rolled up after an extended winter, and they're outside of their Bollinger Band river on the MACD. So Intel and 3M give us some. That's what Intel looks like. Beautiful. A little bit easier to see, I think, on this one.
Thank you. So yeah, I figured I'd do something different that we don't often see in these presentations, and also the chat room.
Pardon that background noise. We were processing the videos from the live trading workshop, and one just fired off there. All right, so we have the RL10 has rolled and crossed. There's our MACD, and the 10's getting ready to cross the dragon. And here, what you can see on the MACD histogram down here, the MACD line, it just entered the spring as it's crossing its 5-period, and it's outside the river. So that's the time that you would expect to find owls, and in fact, that's what we do. You have this unambiguous move down, P1 outside the river, The RLXD is getting ready to cross. The price just crossed the dragon, so the RLXD is going to happen. So this chart here gives you nice early warning for owls on swings. So let's take a look at 3M. You should be able to frame this trade on your own with a stop below the belly of the 10, target 1, target 2. Let's look at 3M. I think that's kind of even better. You already had one, a low, a higher low. The RL10 has crossed the dragon here. You had a really strong close on Friday. You can see we just crossed the 0 line, so we are actually entering the summer on 3M. That's in pretty good shape. If we want to look at some things that are towards the end of the summer, the end of that growing season, let's take a look at Walmart. Special case here. It had that nice big run up, and so that's what drives it into the summer, but it hasn't really followed through. We talked about this one last week, drifting back towards fair value. It couldn't sustain. Let's find another one in summer. Let's take a look at Cisco. So Cisco gives us a summer play right around here, and it's had a nice growing season just towards the end. Actually, it's still healthy in the summer and well above its above the 0 line and its Bollinger Band river here down on MACD. So this is all systems go in Cisco. So if it takes out Friday's high, you can keep going with it. It's at fair value, has moved sharply out of this sideways channel, and it's still in the early stages of its gains. So that looks pretty good. So just some quick ideas on how to use the 4 seasons of MACD to find either owls in the spring, continuation patterns in the summer, how to start protecting against giving back those gains in the fall, and then using the winter to start stalking some interesting areas for recovery, but also when to pile on things that are weak, so like Disney, Chevron, and Morgan. Let's take a look at those on the weak side. So Disney, yeah, coming down to its winter, well below its so any failure of Disney here, then all of this sideways is put at risk, and down it goes. Look at JP Morgan. Also approaching the winter, below its fair value. Any breakdown below 113.80 would be weak. And Chevron. Near the end of its run in the winter. Now this is one where we see that starting to curl up. We would say towards the end of the winter, beginning to go for the spring, and as we said before, that creates a nice owl opportunity here. The end of the winter, the beginning of the spring is when you start seeing the owls organize with nice moves back to the Bollinger Band mean and the RL2 set. This is my favorite setup right in this area because I've already seen the pain baked in and then failure to fail further, and now the resumption of these quality companies. It tends to be my favorite. Okay, moving on. The 30 regression line looking very strong. Getting ready to cross above its 10-period moving average, above the 0 line. That's very favorable. This percent stretch relative to the 200, it's back to the long-term average. It's well above 0. This has been a healthy recovery. 1, 2, 3 higher lows. Getting ready to resume. And if it runs all the way back up to here, this is another $10 in the S&P. And there's no resistance overhead. So the only possible fear there is if you think political shenanigans are going to get worse. It's kind of hard to see how they couldn't be given the Trump noise generator, but the market's been able to shrug off most of that all along. And the hidden advantage of that kind of political noise is that the legislators are too busy posturing for the election in November. But between now and November, there will be no substantive legislation, no discussion in the markets, and the markets like to be ignored by legislatures. It lets the winners continue to win. So I consider that to be pretty favorable. You can see the volatility remarkably low. We have the 90 at the top of its little 1 sigma river right here. So very positive bull. The 30 rolled back into the river, starting to hook back up. The 10 has made some little gains here, but some follow through, and then it's going to get above this previous hump, and it's all-time new highs, and it's hard to argue against that. That's everything I want to cover for this weekend. We will see you in the chat room. We're compiling the notes for the potential November and spring workshops out here in Kansas City. November, late November or early December is looking like a go for both swing and day. So I'll put out something this week to help you get your planning together. Those will be weekends only, so it's a little more convenient for travel. This is Ken of Tortoise Capital. Keep your risk measured and your powder dry.